If you can't find the optimal entry point or you are weak in how to swing, this video is suitable for you because very important things are said in this video. The strength that we can have for classic price action with signs is that in this method, the trader analyzes and predicts the future without any indicators, only considering the patterns that the price is forming in its process. The analytical method allows the trader to set the best trading conditions for himself with the least amount of error. And after all the signals he receives from it will be in accordance with the current conditions of the market. One of the main methods of classic price action is the use of tools and patterns that have been formed in the past in the price chart and are currently used as common patterns for trading. Be careful that there are many patterns used in classic price action, and the high variety of these patterns may sometimes cause confusion for traders. We recommend that if you are looking to use this style of technical analysis to make your trades in the financial markets, be sure to use patterns that have a lot of power and are common among the majority of users. For example, the main and most important patterns and tools used in classic price action are as follows: geometric patterns, Fibonacci candlestick divergences. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot. Be careful that if you can imitate the behavior and trading style of the main players in the financial markets and enter into your transactions according to their trading style, your success rate will increase significantly. Of course, it is not possible to enter transactions in the financial markets exactly according to the entry points of the main players, and no one can read our minds in advance to the main price of the market and trade in the market according to their transactions. But in modern price action you can. By using different methods immediately after the action of the main players, understand their entry into the market, and arrange your transactions based on their behavior in the market with a little difference. In price action, we know that when the price forms higher ceilings and floors than its low price or its previous trend or its old low, the downward trend continues to rise. Registering new means that our trend has reversed to downward. The four important patterns that are always repeated in the market are the price candles that the trader creates. 1. Ascending continuation triangle. An ascending continuation triangle is considered a bullish signal. It indicates a possible continuation of the current uptrend. An ascending continuation triangle shows two converging trend lines. The lower trend line is rising and the upper trend line is horizontal. This pattern occurs because the lows are moving increasingly higher, but the highs are maintaining a constant price level. The pattern will have two highs and two lows, all touching the trend lines. This pattern is confirmed when the price breaks out of the triangle formation to close above the upper trend line. Volume is an important factor to consider. Typically, volume follows a reliable pattern. Volume should diminish as the price swings back and forth between an increasingly narrow range of highs and lows. However, when breakout occurs, there should be a noticeable increase in volume. If this volume picture is not clear, investors should be cautious about decisions based on this triangle. 2. Continuation wedge. Bearish. A continuation wedge, bearish, is considered a bearish signal, indicating that the current downtrend may continue. A continuation wedge, bearish, consists of two converging trend lines. The trend lines are slanted upward. Unlike the triangles where the apex is pointed to the right, the apex of this pattern is slanted upwards at an angle. This is because prices edge steadily higher in a converging pattern, i.e., there are higher highs and higher lows. A bearish signal occurs when prices break below the lower trend line. Over the weeks or months that this pattern forms, the trend appears upwards, but the long-term range is still downward. Trading considerations. Pattern duration. Consider the duration of the pattern and its relationship to your trading time horizons. The duration of the pattern is considered to be an indicator of the duration of the influence of this pattern. The longer the pattern, the longer it will take for the price to move to the target. The shorter the pattern, the sooner the price move. If you are considering a short-term trading opportunity, look for a pattern with a short duration. If you are considering a longer-term trading opportunity, look for a pattern with a longer duration. The next important things are also said in the part. These are repeated. There are many markets that happen in price action. Try all these strategies in the direction of the trend. Thank you for watching the video so far. I hope you can make the most of it. Watch the video related to the strategy.